So economic growth in Australia should pick up in the second half of this year. It won't be a particularly strong pickup, however, although we do think that the strength or the lift in household incomes as the stage 3 tax cuts land, and also as cost of living measures, not just in the federal budget, but various state budgets, boost household incomes. That boost to household incomes will be both spent and saved, but that additional spending by households should help see GDP growth over the second half of this year pick up ever so slightly from what's been a tepid pace of growth over the first half of this year. We think the next move in the cash rate is down, with the first interest rate cut in February next year. We were previously thinking November this year, but there have just been a few things that have caused us to push that view out by 3 months. The first is that inflation has been a bit more persistent. The second is that we're getting ongoing contributions to growth and also ongoing contributions to employment growth from aspects of government spending that's providing a bit more support to the economy. And there are only 2 quarterly CPIs now between now and the November RBA board meeting. We just don't think that'll be enough time for the bank to be reassured that inflation is going to get back to the target and stay there. And indeed, we did get some reasonably hawkish rhetoric out of the Reserve Bank following their most recent board meeting. So November just seems now a little too early for rate cuts to be starting in Australia. Cost of living measures will put a lot of downward pressure on inflation in the third quarter of this year. Indeed, headline inflation could even be zero in the third quarter of this year. That unfortunately doesn't mean we'll get an early interest rate cut. What it does mean is the Reserve Bank will be much more focused on the core measure of inflation, the trimmed mean. Now, we don't think this will be within the target band until we get into 2025. Importantly though, we should get by the very end of this year 2 readings in Q3 and Q4 that have that trimmed mean core inflation on a 6-month basis, annualizing in the RBA's 2 to 3% target band. That and a higher unemployment rate should be enough to get the Reserve Bank cutting in February next year.